Hello.
Hello, everyone. We room getting filled with people. That's super cool. I think we can slowly get started. I'll start with a quick welcome. Thank you so much, everyone, for joining us today. This is the fourth event in our online event series for founders. Today, we're talking about a path that's maybe not have been so glamorized in the startup world, but definitely gaining attention nowadays, and that is focusing on profitability, maybe over chasing funding rounds or fast exits. Before we start, as always, I'd like to briefly introduce ourselves and why we're doing this, why we're hosting this event. My name is Jana, and together with Miri, who's also in this call, we are the co-founders of Beams, or usebeams.com. It's a SaaS tool insights platform where we help companies, like on a deep level, understand which tools are being used internally, who uses them, and if they're actually being used, and with that help them reduce SaaS costs, but also ensure with or help with security and compliance and tool adoption. And as more founders are using our platform to get a quick overview of the tools they're using, for example, during cost-cutting initiatives, maybe during a process of becoming profitable, but also during due diligence processes. And that's why we want to have conversations like this one today to help founders be better prepared. Today, we're super excited that we're joined by Enzo Avigo. He's the founder of June. It's a product analytics tool for B2B SaaS companies. Enzo is a former product manager with June, went through Y Combinator, as far as I know. They raised 2 million from top-tier investors. And what I also find super interesting about Enzo is that he grew his LinkedIn following during that path, during that journey, to over 60,000 followers with really high-quality content. I think that's how I stumbled upon you, how I met you, because I really appreciate your content. So if you are not already following Enzo, please do so now. It's really recommendable. And Enzo and June recently announced that they led their company to be cash flow positive. And that's exactly what we're talking about today. We'll talk about why you made that decision, what it took to get there, and so on. I've prepared a couple of questions to guide this conversation today, but would really love to weave in audience questions. So feel free to engage in the chat. We'll have a look on that. Miri will help me monitor the chat, and we'll weave in questions as we see fit or at the end of this call as well. It's 30 minutes, short and crisp, and we'll hopefully get out of Enzo as much as possible. Enzo, thank you so much for being here. Let's dive in right away. Feel free to introduce yourself, anything that I haven't mentioned yet, yourself and your company, and maybe finalize with where you are at today with June.
Yeah, thanks so much for having me. Excited to meet you, everyone. It's really cool to have this small room. So yeah, don't hesitate to shoot your questions, and very happy to be super open about this topic. I think it's a little bit new for us. I would say it's been an intentional new topics for the last 12 months, and I will tell the story. So I'm still figuring a lot out. So happy to be challenged and to have a discussion. I think you said a lot. Maybe June, you mentioned product analytics for B2B SaaS. I think I haven't updated too well my bio or things like that. I think today we pitch ourselves maybe as an analytics layer for B2B SaaS. So we do product analytics. It's one of the things we do pretty well at the company level. And then we try to, we give a 360 view of your customers, trying to help you understand what they do. And then we will help you, pass this data to the rest of your organization through CRM integrations and things like that. So it's been an exciting and long journey with a lot of learnings. But that's for the company. A bit where we're between seed and Series A. That's the way I usually pitch June, but we're going to talk about whether or not we should do a Series A. I think that's one of the questions we have. So what that means is we shared this week our spendings. We spend roughly $85K per month. And as you mentioned, we are cash flow positive. So we're not profitable. We haven't paid back the money we raised, but we're cash flow positive, meaning that every month we make more than we burn, that we spend. And so, that plus kind of like the growth right now, which is 5 to 10% month-over-month growth, I think give you a pretty good idea of like where we're at in terms of revenue. The only thing the only taboo I think I mentioned to Juliana before we start, the only thing that we don't really talk about publicly is our monthly recurring revenue, because we're still VC backed, but I'm sure there will be a point where we start to be even more public and vocal about this one. Yeah, so that's a little bit about the company where we're at. I mentioned a team of 8 people, mostly engineering focused. Half of the company are product engineers. The rest is design and some go-to-market, and I'm part of the go-to-market side of the company right now.
Cool. And thanks for differentiating between cash flow positive and profitability. I think that's already important note to take here. Let's maybe start a few years back, because you also said VC backed, you raised a seed round. How did you think about using that capital? What were the main priorities at the time? And with that, then later I want to ask how that shifted, but let's start with that.
Yeah. So I was preparing for this conversation, and I was trying to understand how we allocated money at June, right? Like, what was the formula we used? And actually, it's been very simple. So we started in 2021. We were 2 people, no saving, no money, basically, no unemployment wage even. And so we had to look for a little bit of money just to survive. We raised from angel investors $50K, which is like enough money to be 2 and just like have a very lean year, right? Like you barely can pay holidays, but you can still rent an apartment and have some lunches, let's say. And we started like that. We got pretty lucky. After 4 months working on June, we got into a Y Combinator. And within 3 months, we pulled out a beta of June, which had, I think, 300 monthly active users. The curve of monthly active users looked pretty good. And at the end of Y Combinator, we were able to raise a round of $1.6 million, which was kind of tiny at the time, because, just to put you back in context, 2021 was really the peak year of investment, a lot of liquidity going into the market. We had, I think, good pedigree, like we came from great companies. So great team, I think great idea, I hope. And then YC stamp was enough for us, and like some traction on our monthly active users, no monetization, was enough for us to raise a round. At the time, we raised really the minimum we could. So I don't think that's something I shared publicly, but we raised 1.5 out of a round that was committed at around 8 million. So we raised like less than 25% of what was committed. And it was really scary, to be honest, at the time, money with good valuation, and you could just take more money. But my co-founder and I have always been big believers that when you operate under constraint, that's how you figure things out. So we got this money in the bank. Imagine June as like a little bit over $1.5 million 3 years ago. And then the question is like, how do you spend that money, right? The thing that YC taught us, which is very simple, stupid almost, is that when you're still in this phase of finding your product market fit, you should keep your expenses very low. And the magic number they came up with that we ended up adopting was $50K net dollars per month. So kind of like what they found out, I don't know, advising hundreds of companies, thousands of companies, is that with something around $50K of burn, you probably have enough of an engineering team and a go-to-market muscle to figure out your early PMF. Obviously, this is an average, right? Every company is different. If you're like more ops heavy, if you want to launch a new scooter company in Berlin, like you probably need more than 50K. But for software, pure software play, where the differentiator would be a better product, a better SaaS product, it sounds like it was a good number. So if you put like the 1.5 mil in perspective with the 50K, that's a very long runway, right? That's 3-4 years of runway. So I think that's what we went for. And progressively, we started to increase the burn. At some point, we started to generate revenue, a couple of thousand MAU. We thought this would be the good moment to a bit push on these expenses. that has been a little bit like the structure. There's lots of other pieces that came into play. So after 1 year, so we took 1 year crossing the desert where we had no revenue, just MAU. After 1 year, we started to monetize. I think we started by charging $50 a month, then 100, then 150. We were doubling the price until it breaks. And we found out that for analytics for B2B only, above $150 started to be kind of expensive. So we, at this point, I think the growth came mostly from the top of the funnel, but didn't come from the ACV, increasing the basket size. So we went from like 10K, 20K, 30K MR, something like that in like 1 year. And at some point we reached the end of a model where there was only 2 exits possible. One was fuel the top of the funnel, just like have a lot more customers, or the other one was go up market and start to sell to higher customers. Or we can do both actually. We tried very hard to just increase the top of the funnel. The problem with like small businesses is that they die by nature, or they will churn from your product because even when they pivot their business, they maybe don't need an analytics solution. And so we had churn issues. We had 3 to 4% month over month, which is not insanely bad. I think it's actually quite the benchmark in the bottom of the market, but it's kind of like annoying that you have to still catch up on that. So the second phase of June was us going more toward Series A, Series B companies and try to increase the ACV. At this point, what we found out is that our initial value prop, which was a plug and play analytics, resonated a lot with the bottom of the market, the early stage startups, but a lot less with the middle of the market that wants deeper answers. And so we had one option, which was like, let's just go up market and become like the product analytics solution for B2B SaaS. Let's compete with Amplitude. Let's compete with Mixpanel, but for B2B SaaS. Or maybe there is something else that allows us to expand the revenue that would be more exciting. And at the time, what we found out is because we had built a very simple analytics, we were attracting a lot of different personas within the organization. So founders, product managers, customer success, growth managers, and we started to talk with them a lot. And what we understood is that the reason they were hiring June, so the job they were hiring us for, was actually to retain their customers. And so we decided that we would lean into new features that would help our customers keep their customers. So this is the company profile, this is the CRM integration, things like that. At this point, like we were able to triple the ACV. We moved from $150 per month to $300, $400, $500 per month, and that's where really we've seen a new kind of growth kicking in. So June growth looks like that. Then it's a bit slower, and then there is like the new plan and it kind of goes up. Eventually, at some point, I'm touching a lot of things here, but I think the growth of June had to do a lot with our efficiency in terms of go-to-market and attracting new potential customers, but also on working on the fundamental of the packing and packaging and pricing to make sure that whoever we were talking with would get a lot of value from June, and we would capture that value. Last thing on this one, I think looking back at June, I tend to think that there is no really middle ground between a mass market SaaS and an SMB SaaS. I think even if you sell to a Series A, Series B company, you will have to put a lot of resources to onboard people. When they buy a SaaS for a couple of $100, they just want it to be set up and work, and you will have to invest as much resources as possible with them to make sure they're well set up and successful. And it's pretty much the same amount of work you would put with like a Series C, Series D, or maybe not enterprise because there is more like regulation, but much larger companies. So we were a little bit into this middle ground where we're trying to please the smaller companies, the smaller startups with which we had a lot of empathy with, and which that we were, a couple of years before, and kind of this mid-market doing this transition from like, the bottom to the middle of the market. What we found out is that with a team of 7, it was impossible to sustain. So we decided in September to shut down our free plan and just have honest conversation with people like, what's your use case? Can you deliver the value, to of the use cases that you have, and then can we capture that value, aka can we monetize, in front of that. So that has been like very the different motion, the different stages of our company in the last 3 to 4 years. 1 year to build a product, then monetizing like $50, then 1 year to have a few customers spending $200-300, and then 1 year later, $400-500 becoming kind of the default plan in the product, and us being slightly more mid-market. Still early, like Series A, Series B, but like way up market compared to where we were before.
Cool. Thanks for touching upon so many things. I think this interesting search journey of searching for product market fit is something that most of us founders here can relate to. During this journey, was there any specific moment, or at what point did becoming cash flow positive become a focus for you? Was there also like a specific trigger or a shift towards that direction?
Yeah, that's the why we're here today. So I mentioned we had this kind of long runway of like 3-4 years, and us spending like 50K a month, then 60, 70, and then at some point it was even higher, and then went to 100, and then went back to 80. What happened is that over time we were making money, but less than we were spending, and so at some point like the runway becomes something realistic, right? It's not like 3 years, it's like 18 months, right? And I think this is where we have some questions about, if we're not able to pull out the revenue, is this company going to be dead in 18 months? And if so, is it fine, right? Like we gave it a shot, like 3 years of like 2-3 years of our life. That's enough to figure out if a business is, is viable or not. At this point, we decided that we wanted to increase the burn and take more risk. But at the same time, we still wanted to give ourselves some time. Like what we knew at this time was that to penetrate the market we're in, it really takes time to build a great product. And this is usually an excuse that founders give themselves, and we were very worried about, like, does it really take some time? But the past had proven to us that it takes more than 1 or 2 years to build something decent. You need something very reliable, otherwise people don't trust you. You need something that's scaled because people are sending you like lots of data by nature in this industry. And so this is taking, resources. We were, I think, in 2023 when we started to see like the runway shrinking to 18 months. And at this point, we had a big conversation with our board, and we said, look, we think we should keep moving and kind of buy ourselves some time to figure out a very hard PMF. I think we had a PMF that was pretty soft. We didn't have a good PMF with like the new market we're getting into, and so we wanted to buy a bit of ourselves some time. At this point of time, the investment economy was down very, very brutally, very different from 2021, and so we thought that if we could run the company lean, keep growing the revenue, it would put us in a great situation where we would be able to go to investors and say, look, we are growing, we're making money, like the trajectory is great, which is the first thing they look at, but we're also super capital efficient. We were able to do that with only a team of 7. So if we were to invest more resources, we think we could go like faster than anyone else. So we agreed on this narrative with our lead investor, which is one person. Literally, the board is very small at June. It's my co-founder, lead investor, and myself. And we started to really operate under constraints. The growth was a bit slower. I think at this point we kind of trade off the growth. But what happened is that the MR kind of like started to catch up with our spending. There was one big pivotal moment in October 2024, where we killed our free plan. We made our pro plan the default plan, which was our most expensive plan, but anyway, the reason why most people were happy with the product. And we started to do yearly payments upfront. This had the biggest impact on June. Like suddenly, I'll give you an example, but if you're burning 80K and you make, I don't know, 50K of MR, and then you're able to charge 30K upfront, of net new MRR, you are profitable. Sorry, you're cash flow positive on that month, right? So that all it takes, charging your yearly upfront can massively, if you have like good closing rate and like you're making like a decent amount of MRR every month, it's all it takes to really move from like, we have a runway that might be like, 16 months to, oh my God, we're profitable or cash flow positive. I keep saying profitable. And that moment was very pivotal for us.
Interesting point of the yearly prepayments. We have two questions in the chat that actually fit quite well, I would say. One from Bahadir, he asks, did you grandfather the older customers when you increased the prices? And he says, I guess I'm still using June for free.
So we, yes, we kept people on the free plan, and we still have a lot of people on the free plan today. Yeah, and then I think we initiated a lot of the conversation with the people we thought were not getting the most value out of June on the free plan to see if it would make sense for them to experiment the pay plan, and in exchange of that, we offered discounts. This has been one of the trick of June, trick sounds like we're tricking people, but this has been one of the, I think, best practices of June. Every time we introduce a pricing or a new pricing, we always gave something in exchange for the earliest people to cross the line. So in the beginning, June had only active users and was free. One day we introduced the pricing, we're like, look, June is going to be $100. If you move on the pay plan now, it's going to be $50 for you for 1 year. It's an amazing way to move people from like a free to paid. Then we had the same with paid, the growth plan, which we had, which was the intermediary plan, to the pro plan, which became the norm plan at June. We said the same, like this pro plan is like $400 a month, but we can make it $300 if you're ready to move it with us.
Okay. And the second question touches upon something you also mentioned. So you shared how you defined this new narrative also with your existing investors, but how has it shaped conversations with potential investors or maybe also acquirers, like generally with the external perspective? How has this shift to become cash flow positive changed your conversations?
Yes, great question. So as soon as you mention online that you're cash flow positive, you're going to be reached out by a lot of investors that want to acquire a profitable business. So PE funds, investors, SaaS groups that are running multiple SaaS in parallel, often like bootstrap kind of businesses. Depending on how much you've raised also, you might fit into different categories. Because June raised relatively small money, so 2 million, a bit more than 2. It's kind of like easy to buy out June, right? You can still put 2 million on the table and run June. So we got approached by a lot of these kind of investors, basically. So that's what what can happen. I think it turns off a little bit more the strategic investors. So by strategic investors, I mean people that have an interest to add your technology to their company, because so let's say, I don't know, you think about a user engagement platform that has like tours and notification. Maybe they want an analytics product so that it's complementary, right? As soon as you announce that you're cash flow positive, these people think that you're more in control of your business, which is true, and that you will keep running it, because now you can basically do whatever you want, not entirely, but kind of. And so they will kind of like be, I found these people to interact a lot less with us, which is cool. And for your existing investors, I think your existing investor, I keep thinking about my partner in life, like my wife. Basically, I think it's just you just need like very transparent communication, and just if you do so, usually you get to some sort of alignment. So for our existing investor, I think he was very happy that we pushed that to the limit of us being fully in charge of like our destiny. And for VC, what matters most is like how fast can you grow. So they see that as a mean to you being able to buy yourself more shots or more time to reignite some sort of like blitz scaling, like some sort of fast growth. Like we have blocks of technology basically in our company that enable, if we build on top of them, to hopefully accelerate compared to a business that would just start, I think a great example is Lovable. Lovable is like booming right now. People think it's like a young company. It's more than 4 years old. And there is a good post from the founder that explains that without the technology they had built in the first 3 years, they would never have been able to build Lovable in like 8 months, basically. Like everything is based on the first years of work. So that explains. Maybe one thing that has changed in the meantime, June becoming like super cash efficient and even like cash flow positive, AI kicked in.
Mm-hmm.
I changed the entire game, meaning that we could have gone back to the investors saying, look, we're cash flow positive, we're like super efficient and so on. The truth is like now they are comparing you to all these AI companies that grow super, super, super fast, like making millions out of 2 people in a couple of months. And here the decision we have made, which is very specific to June, but you know, we knew that we could pull a next round of funding, but it would take us months, probably like 2 to 4 months seem to be like the classic roadshow time that people invested. And we thought it would be a better usage of our time to keep growing the business instead. So we've kind of like, you know, put a little bit on the side the fundraising conversation. We don't know if we're going to do a Series A, if we will want to do a Series A and just like keep chasing that hyper growth in the future. Maybe yes, maybe no. But as of today, what I can tell you is the latest decision we've made brought us to where we are, and this is great because we can operate the company the way we want, basically.
Nice. Yeah, thanks for also sharing a quick potential outlook for your company. We have 2 minutes left. These 30 minutes usually go by so fast. So maybe a final takeaway or for the founders here in the audience, what would you say how to think about maybe balancing profitability and fundraising, one thing over the other? Any signs where one or the other might be the right move out of your perspective?
I mean, yeah, one advice that I keep giving my friends who raise money or have raised money and things like that is, I think the most important piece of the puzzle is the time you will need to figure things out. Really, what you want is enough cash to do your iteration, do your test, and I think it's important to be honest with yourself. Like, okay, I'm launching in this market. I know this market needs that. It will just take me 12 months to put it out. Or I launched in this market, like we launched in the analytics space. We didn't know exactly what was going to click. We bought ourselves 3 years, and it took us, 2 to figure it out. Great. So I think the real question is whether you're like about to raise a pre-seed or a seed, or you're thinking about doing an A and so on. Figure out how many iterations you think it will take for you to reach the destination you want to be at. It can be product crafting, it can be figuring out your go-to-market, it can be figuring out your pricing so that people resonate with your pricing, and how many iterations it will take. Some iterations are fast, pricing can be changed overnight. Some iterations are long, like building a product is like 3 to 6 months, iteration when you want a core function of your product to be changed. And based on that, what's the amount of capital you think you will need and resources to get to that. And if you have this money in the bank, then great. Maybe you don't need to raise again. Keep your equity, but don't. If you're thinking about raising again from a VC, like don't jeopardize your growth, because eventually AI is all over now. They will judge you on the growth, and so that's going to be a key criteria of your thesis. So that's also something that has impacted us in our decision to not chase capital too much, but kind of like do our own thing.
Nice. I think that was a really good way to end our call today, with a nice advice to everyone here in the audience. Thanks for everyone for joining, and especially you, Enzo, for sharing these insights. I think this were 30 minutes packed with your learnings. You mentioned it was also good for you to reflect a bit upon your journey. So thank you very much, and have a great rest of the day, everyone. We'll send out an email with the recording of this and some more details about June and also about our product themes. So thanks, everyone.
Thank you. Have a good one. Bye-bye.